Okay, welcome to part 2 of our accounting primer for managers. And here we're going to discuss the core of an accounting system. When I think about it, do you admire when someone comes up with a very clever but brilliant way of solving a problem? Well, that's what the core of accounting is. And interestingly, it didn't come about in the computer age. It's been something, from what I've read, that was devised centuries ago in the Middle Ages by some of the large trading companies, I believe, in Europe. And that technique is simply mimicked by computer accounting systems today. Now, as a manager, maybe just to give you one precaution, you don't have to understand this technically, the details of everything we're going to discuss. This is more of an overview. I think of it as like when you drive a car. I drive a car, but I don't work on an engine. I know how they work roughly. In a general sense, but the only thing I might change the oil on my motorcycle, but I don't do any of the mechanics on an engine, even though I know how it works. And similarly with this accounting, hopefully when we're done with this part, you'll have a decent understanding of how the internals of the accounting system works to track all that activity. But your bookkeeper is the one who will be doing it, and they'll have a deeper understanding, which is sufficient for what we need to be a good manager, or you need. Okay, on to the core. And we talked about the chart of accounts, and we mentioned, or we demonstrated 3 transactions in the chart of accounts. Well, the program that contains all that, where you'll find the chart of accounts, is called the General Ledger. It not only contains the chart of accounts, but it's also the repository where all the transactions, all the activity, all the entries are stored. I've used the word transaction because in accounting, that's what you would refer to those things we did. We did 3 transactions, and in the General Ledger, they're called General Ledger transactions. And here, on the upper part of the screen, you see those 3 transactions. The first one, when we got our loan, we put money in the checking and we recorded it against our liability loan account. Then our second transaction, now you'll notice on here I list the accounts in the order they are in the chart of accounts. So it's typically the way you would show it. Assets followed by liabilities, followed by revenue, followed by expense accounts. So in our second one, where we paid the rent, we showed the asset account checking going down by $500 and our rent expense going up by $500. And similarly, our third one, where we sold the widget, our checking account, the asset account went up by $1,000, and our revenue account, the sales account, also went up by $1,000. Now, if you've had a checkbook, and most of us had, you recall how you would maintain the balance of your checkbook in that little ledger where you would enter the entry for a check you wrote or deposit you made, and then add it to the total above it to get the new total. Well, an accounting system is doing a very similar thing for each of the accounts separately, as if we had a checkbook ledger for each account there, checking, loan, rent, and sales. But they write it out in a flat way. It's a little neater to look at, and that's what you see at the bottom of the screen. The same 3 transactions as up on top, but written the way an accounting system would think about it. First they show, if you look, they're the same 6 lines, but they show the starting value, then how much was added to that account, followed by how much was subtracted by the account, and then the ending value. So we see in the first one, checking and loan both started at 0, both went up by $1,000. They didn't go down by anything, and they both ended at $1,000. Similarly with the second one, the checking account, this time starting at $10,000, sorry, not $1,000, $10,000, didn't go down at all in the second, or didn't go up at all in the second one, went down by $500 and ended at $9,500. Our rent, which we call rent as an expense, it started at 0, but it went up by $500 for our first rental payment, but it didn't go down at all, and it ended at $500. And finally for our sales, this time the checking account started at $9,500 from the previous transaction, but it went up $1,000, didn't go down at all, and ended at $10,500. And finally, our sales did it similarly. It started at 0, it went up by $1,000, didn't go down at all, and ended at $1,000. So, sorry, that's rather long-winded, but just to point out, that's the way it would lay out in an accounting system. Now, interestingly, what if we totaled it by the 4 account numbers we see there? There's 4 accounts: checking, loan, rent, and sales. We could do that in our head, just add those together, but I'll show it to us on the next screen. Here they are, totaled. Our checking account started at 0. If you recall, it went up by 1,000, down by 500, and then up by 10,000, down by 500, back up by 10,000, ending at $10,500. The other 3 only had one entry. The loan up by $10,000, the revenue $1,000, expenses $500. Okay, again, sorry for all these numbers, but there's nothing too astounding here, is there? But here, the next part is what was clever. Think back to when you were in school. I want you to think about this, a little bit of math. Most of us can remember this. In school, we learned that if we took a number like 4, added 2, which would be 6, and subtracted 1, we'd get 5. Okay, not too challenging. But we may recall, if we reverse the order of the adding and subtracting, we take 4 and we minus the 1, we get 3 and add the 2, we still end up at 5. And they had a big name for that, but basically that it didn't matter whether you did the addition first or the subtraction first, you would always end up with the same numbers. And that's the part that was really clever. I do not know who came up with it. But someone came up with this system. Take those same numbers we have up on top, but now in the middle 2 groups, the liabilities and the revenue, you notice I put them in italics over here at the beginning. The liabilities and revenues, let's switch these 2 columns around and put the minus first, then the plus. The minus first, then the plus. Okay. Since we established up here from school, that gives us the same concluding numbers we had up here. So what did that accomplish? Here's the part that was clever. When you do that, mathematically it doesn't change anything, but look at this. If you add these 2 columns after you do this, the columns are equal. That wasn't true up above, but if you take these middle 2, reverse just the order of them, then your second and third column will be equal. Now, we did this on a total of 3 after 3 days in our fictitious business, but it turns out this will be true no matter how you do it. If you do it after a month, if you do it after 3 months, a quarter, or a year, if you reverse the liabilities and the revenue, the columns 2 and 3 will always be equal. And that's what was ingenious, that someone figured that. As a matter of fact, they named those columns, and we'll show it to you. They're terms that you've probably heard and wondered what they were, and that's debits and credits. For this layout here, and again, you see the liabilities and the revenues, which are in italics, have been reversed in their order. The column 2 is called debits, column 3 is called credits, and the columns add up to the same amount. Or in a word, we say that the debits equal the credits, and that'll always be the case when you follow this formula, the system, simply reversing the liabilities and the revenues from the assets and expenses. Matter of fact, this is so significant. There is a third financial report, not one that generally is published, but it's used by bookkeepers and people they interact with on the outside, like accountants and auditors, where if an accountant's coming in or an auditor and wants to check out the books, one of the first things they'll ask for is a report called a trial balance. And that's what this is. Trial balance is simply a list of all the accounts with their total debits and credits. And if those totals match, that's a good sign that the bookkeeping is being done well and being done properly. The second reason why the trial balance is popular is it lists all the accounts. You can't tell that very well here because we only have 4 accounts we've been using. But if we had 150 accounts in our chart of accounts, they would all be shown. first the asset accounts and the liabilities, followed by the revenues and expenses in order. Now, unlike the balance sheet and the income statements, which only contain part of the account numbers. So that's a second reason. Now, another term, two terms actually you'll hear are the terms debit account and credit account. And what they refer to is, if again looking at our chart, the outside too, the assets and expenses are called debit accounts because debits increase them, whereas liabilities and revenues are called credit accounts because credits increase them. Now it's worth pausing for a moment here just to sort of get this burned into our memory, because it's a useful thing to remember is, which are debits and which are credits. And I like to think of it two different ways. One, it's sort of like a sandwich where the assets and expenses are the bread. They're on the outside, they're the debits, whereas the inside of the sandwich are credits, the liabilities and revenues. We get used to that. And the other thing you notice about it that I wonder if it's part of the reason it works so well is the mirror effect. If you look, the top two accounts are the balance sheet accounts, and within the balance sheet the liabilities are a mirror to the assets, so they're flipped over the other way. And similarly on the income statement, the revenues and the expenses are a mirror of each other. But more than that, if you look, the income statement is a mirror to the balance sheet. In the income statement, the credit accounts are on the top and the debits are on the bottom. So anyway, if any of those help, it's just useful to remember assets and expenses are debit accounts, liabilities and revenues are credit accounts. Now, all that being said, that actually isn't the most ingenious part. And what we're about to show you next is even more incredible and also greatly simplifies your life and understanding accounting. And that is this. Here, we've portrayed the same three transactions we've been using all along. Our loan, our rent, our sales. But in this case, they're laid out like they were a few screens ago, except we've taken the two, the loan, and you stop to think a loan's a liability account, and the sales, which is a revenue account. They're in the middle, they're credit accounts, and so on these two, we've flipped them around from the way they were several screens ago, where we just had them, in order. But you notice the effect of doing that when you do that, it turns out every transaction in the general ledger has to balance. The debits have to equal the credits. And so you see here, the debits and credits are 10,000, here they're 500, and here they're 1,000. And all because we reversed the inner two classes of accounts. Each one of these transactions balance. That also helps us understand why you can have 10,000 transactions and not have to worry about how do you keep the books in balance. Each transaction has to be in balance. This was such an important thing. I'm starring it here. And this is the last thing we're discussing. So as a manager, that's really what we want you to appreciate or get from this segment of the primer, is that an accounting system stays in balance by keeping every transaction in it in balance. Now, this may seem intimidating since a given accounting system, and even an average business can have thousands and thousands of transactions a month. But it turns out it's not all that overwhelming. As we're about to discover in the next part, almost all the transactions in the general ledger are being fed there by one of the other parts of the system. And all the other parts of the system only feed the general ledger, the balanced transactions. So, time for another break, and then maybe we'll resume with the part, let's see, it's part 3 then, the overall system.